Good afternoon and good morning, depending on where you are. My name is Jeff Tucker, CEO of Tucker Company Worldwide. And today I have with me Lee Klaskow, Senior Analyst for Bloomberg Intelligence. We're going to be talking, we're having a conversation today a little bit about the freight market, the trucking market in particular. I just want to let you know, folks, this is being recorded. This will be available afterward for colleagues and you to share within your organizations, and we'll send that out to all those registrants. Additionally, this is a 15-minute presentation, so we'll talk a little bit for 15 minutes. I'll ask you to use the chat buttons, the Q&A button to offer your questions, your thoughts for Lee or me to comment on. Also, wanted to give a big shout out Jennifer Hedrick, former executive director for the National Industrial Transportation League. I'm on the board of and served there for a number of years. Just received a CEO position at Women in Trucking, great organization. Google it, womenintrucking.org. You could visit. Great organization, and wish Jennifer and that organization well in the future. So, Lee, welcome aboard.
Thanks, Jeff, and congratulations, Jennifer.
So, why don't you, maybe I'd like to ask you, because we've asked you a couple of times, we've had you on these calls before. I'd like to ask, first of all, what is the consensus right now in terms of, are we heading for recession in 2023?
Yeah, so on the Bloomberg terminal, consensus for a U.S. recession is around 60%. That's actually slightly down. It peaked at 62.5% a couple months ago. Not sure if people are just becoming a little less pessimistic or just a rounding error. But it does look like that the economy is heading towards something of a recession. I joke around that I think that any recession, it could be named after me, being short and shallow, and not a really big deal in terms of the overall economy. Obviously it's going to a slowdown in the economy is going to affect different people in different ways, and some more than others. But the reality is the slower growth or no growth or negative growth is really needed to slow down the inflation rate that we've been seeing, and that's been moderating, so that's been a good sign. And the Fed keeps on raising interest rates to kind of tamp the brakes on the economy, to again with the purpose of lowering inflation, which a lot of us aren't really used to. I barely remember the 70s. I was a very young kid then, so this is something new for a lot of us.
Yes, same here. It is new. I mean, we really we in trucking, we saw inflation happen summer of 2020, right? When freight rates went crazy, but they went crazy because whole industries shut down, right? Or whole industries shifted, and people, and then certain other industries exploded, and this incredible shell and pea game and bidding wars started. And I think, at least from my perspective, in being involved in transportation as much as we are, I kind of feel like that was the start, and I don't think that supply chains are yet normalized yet. Or I hear from consumer products manufacturers and even grocery chains that their fulfillment rates are still in the 60s and 70s. And to me, until that sorts out, until they get back into the 90s, to me, I don't know how we get out of this inflationary period. But am I off track in that perception?
No, I don't think you're off track, but I think what the Fed is doing is going to have a pretty big impact. I mean, if if houses are more expensive or cars are more expensive, we're just going to be buying less. If our credit card is more expensive, we're going to be buying less. You have that coupled with people kind of pivoting towards, oh, I want to buy more services and stuff, because during the pandemic we were all buying, stuff at home and getting it delivered at home, and now we want to go see the world because the world's a safer place to go out and about in, at least here in the United States. So people are spending their money on less things. And so, with that demand drying or reducing for less things, you're going to have, you're going to have negative growth. And, you were asking about a recession earlier, and there's usually three things that have to happen for a recession. There has to be an inverted a yield curve, which means, short-term rates are higher than long-term rates. And then you also have to have a commodity shock, which, as everyone knows, we've had that already, whether if we're talking about fuel, the cost of food, all these things that have just skyrocketed over the last year. And then you have to have, the Fed raising rates. And so we've had those three things. Typically, not all the time, but typically when those three things happen, we usually have a recession, which is loosely defined as 2 consecutive quarters of negative growth. The shocks that the trucking industry has seen, they were dealing with higher prices because some of it had to do with equipment. They couldn't get the equipment that they needed, and therefore equipment prices were extremely high. We're seeing those coming back down to normal. Used prices are for tractors and trailers have been coming down from the peak from earlier in the year. So that's a good sign. Some things that won't go away are higher insurance costs. The industry is facing higher insurance costs kind of more broadly, and that's related to these these really large verdicts, which the industry calls nuclear verdicts, that some of these large trucking companies are facing, as lawyers are looking at trucking companies as organizations with deep pockets. And so when there's an accident, obviously accidents are bad no matter who's at fault. The lawyers are kind of going after the trucking industry, and jurors tend to be favorable to the non-trucker or the plaintiff. So there's that aspect of it as well. And fuel, obviously fuel is still relatively high. It's come down a little bit, but a lot of trucking companies, especially the larger ones, have sophisticated fuel surcharges, but that doesn't really count for idling or sitting around, which unfortunately a lot of truckers have to do when they're waiting for a load or dealing with traffic in general.
So as we segue into trucking, into transportation, where do you see trucking demand, both contract common, contract and spot, as well as any other areas that you'd like to talk about? Where's demand going to be in 2023?
Yeah, so the spot market, we see it to continue to deteriorate. Most of the companies that we cover don't really play that much in the spot market. We cover the large publicly traded companies like the JB Hunt Warners and Knights of the world. But we use it as the canary in the coal mine, kind of use it as a leading indicator. It tends to lead to contractual market. We think that rates could start bottoming late first quarter into second quarter, and then kind of start rebounding up towards the latter half of the second quarter. That's kind of like our base case scenario. And what that means for contractual rates is net in 2023, we think contractual rates will be down by mid-single digits. And that's not to say that every lane's going to be down by mid-single digits. There are certain lanes that were priced more or less like a spot contract, but it was done contractually. Those rates, those type of lanes are going to go down 20-25%. But everything else is probably going to be, flat to down, low single digits. Because at the end of the day, we just talked about all these inflationary pressures that trucking companies are facing. If they're not earning a certain return on invested capital, they're just not going to do the business. And if they're not going to do the business, then, shippers are going to find themselves in a difficult position without the capacity that they need. Right now the spot market is relatively loose to where it has been historically, and that's been pushing rates down considerably lower. rates are down about 27% year over year, excluding fuel surcharges. You know, but they're still up around 10% from 2019. I mean, 2019 was a very depressed time, but you know, they're still up above the pre-pandemic level. So it's not 100% doom and gloom. You know, what we hear a lot is, you know, how tough it is in the spot market, and I don't doubt that whatsoever. And we expect the spot market to continue to rebalance. And some of that is being driven by a lot of folks got into the business. They bought expensive equipment when equipment prices were high. They got into the market because rates were extremely high. And now that high cost operator, it just doesn't make sense in this new normal. And that capacity is going to get pushed out one way or another. And you're going to see a rebalance. You know, we still view trucking as having supply issues, and people might poo-poo me when I say that, you know, or when we talk about a quote unquote driver shortage. The reality is there's a lot of demographics going against trucking. And you know, it is a very tough job. There's high turnover rates among truckers. You know, and so the industry has to do a lot of different things to try to attract drivers. You know, whether it's, you know, casting a wider net and, you know, embracing and actively recruiting more female drivers, because, you know, they make up a real small percentage of the industry. I think the latest stat is like 8 or 9%. I know the large publicly traded companies that have to do with you know, environmental, social, and government issues, or, you know, what we call on the street ESG. You know, when they have to deal with these issues, that's an extremely important thing, is having, you know, a more diverse workforce. So they're actively seeking, you know, those workers out. But also to counter that, you know, these large companies have more stringent hiring practices where they use hair follicle testing, which, you know, might not work so well for you, Jeff. But you know, it does catch, it does like preclude a lot of people that would normally go through it, that would normally pass a typical urinalysis test. And so they just have a much stringent benchmark when they're hiring people. So, you know, they're casting a wider net, but they're being more picky with who they're hiring. And some of that pickiness is driven by, you know, we were talking about the nuclear verdicts earlier. You know, they want to make sure they have safe drivers that do everything in their power to make sure, you know, that not only the load gets to where it needs to go, but the driver gets home safely to his or her family.
Yeah, that issue of the nuclear verdicts, we in the Transportation Intermediaries Association, or TIA, have been asking Congress for, oh God, it goes back to 2006 when I got involved with this, but you know, really religiously in the last 10 years, for a national hiring standard to at least have some level of due diligence required, but also to put these cases into federal court, because it is interstate commerce. The worst of the verdicts usually come in a state, from a jury in a state, and state laws are applied unevenly very often. If we think that federal jurisdictions are inconsistent or consistent, let's say, in their viewpoints, states are far worse. So we've been trying to establish a national hiring standard, at least to get some parameters around the hiring of motor carriers. Doesn't speak to the drivers themselves, but yeah, I can speak even from an intermediary that has never owned a truck in 61 years. Insurance premiums have just skyrocketed in the last several years due to this. You know, I want to talk a little bit about, you know, we just before the call, we were discussing, you know, some of the areas, and we just have a minute or two before we go into questions, some of the areas that are a little less likely to see too much of a change in terms of rates and demand. And that's, you know, if you've got you're delivering into consumer products companies, into major retailers that have the compliance fees, the on time, in full, or any variety style of compliance fees for not delivering on time or not delivering in full, or rescheduling and all the different things. that, in my experience, and it's kind of funny thing to say as a transportation provider, but it's these last couple or 3 years have been the first time in 61 that we've ever been measured and rewarded based on time. And I think that because, fulfillment rates are still in the 60s and 70s for a lot of suppliers into retail, transportation has taken on such a higher importance, and then competent transportation, meaning on time, highly on time, is even that much more important. And I'm just curious if what you see in that area, you see that as maybe a slightly different market.
Yeah, and that's, when we're talking about, earlier on the contractual side, how, we think that most lanes are going to be flat to down low single digits. And the reason is because most of that contract business that I'm talking about is the business that you're talking about. So this is, the large accounts that a Werner or a Knight-Swift, might have, and they're dealing with, very large, retail customers. And some of those customers are more insulated from recessionary pressures, like the ones that that service like the dollar stores or the Walmarts of the world. People tend to trade down during tougher economic times, consumers do. And so, those lower end stores, tend to do very well through the cycle relative to, higher end stores. Or mid-level stores, I should say, because usually the high end always does well, it seems. So yeah, so that's why there's a total premium put on that kind of on-sign service. And that's why consensus, when they're looking at the truckload carriers, they're not expecting a huge decline in revenue. They're expecting revenue to be down low single digits to flat next year, and earnings to be down maybe around 15% for the truckload carriers. Not as bad for LTL, just because of they just seemed in a better position because of the LTL world is just much better pricing, because the top 10 carriers, they have like 80% of the market, something like that. So pricing is a lot more rational, as opposed to the extremely fragmented truckload market where the lowest price sets the new bid. And if somebody's just trying to get home, they don't really care about making money, that sets the new price, which is one of the big problems with trucking, and creates somewhat of a boom bust industry, especially as you're looking in the spot market. What we've been seeing in the large publicly traded world is that a lot of these trucking companies are looking to diversify, and whether that's in diversifying into non-asset businesses like into brokerage, or intermodal into more of an asset-light business. We've also seen companies like Knight-Swift looking to get into the LTL business because they view it as more steady. It tends to get better multiples in terms of their stock. It has better margins, and even though it's a more asset-intensive business, you're seeing fewer and fewer large trucking companies that are just a pure play truckload company. And I think as time goes by, the ones that are still around are probably going to look to being more diverse 5 years down the road.
Well, folks, remember, if you have questions, you can use the chat button there. And want to thank you for listening to a shallow, short guy and a bald guy talking freight transportation.
But your beard's spectacular, Jeff. So
well, thank you. It's I'm growing it to the end of the year, and shave it down quite a bit soon here. I'll ask. We still have a number of folks on, and I'll ask you. That was Alan Greenspan, I think, coined the phrase irrational exuberance around the turn of the century. You can say that now, 22 years later. The way I always see the run-ups of these, the owner-operators, our data showed owner-operators represent, or small fleets, super small fleets, represented 54% of all drivers at the height. And again, we had 10 years of a really good cycle. We can now call it most of 12 years of a really good freight cycle. And at the end of each one of these boom periods, you have a lot of owner operators left kind of chasing rates that were happening a year ago, as you were saying, with that big expense. Like from your perspective, what portion of them are going to kind of run to the big carriers, right? To sign on with them for a little while and run with them for a little while, and then what percent like just completely disappear or might disappear for until the next cycle?
That's a fantastic question, and my crystal ball is not only foggy but cracked. But what I would say is that people with a CDL can come in and out of this business, and while we're on the cusp of maybe going into recession, and we're hearing more and more about layoffs, labor is still in short supply across many industries. And so a lot of those drivers that came into the market might leave and go to a different industry. It could be short term, it could be long term. Those industries could be somewhere closer to home. And then you'll have a lot of folks that might go work for company drivers, but people that tend to want to be an owner operator have that independent spirit, and might not do that well working for a company long term. And at the end of the day, the large publicly traded fleets, they're not expanding their one way, over the road, irregular route trucking fleets, because it's not a great business relative to other transportation businesses. They'd rather be in dedicated. And dedicated routes can be an awesome employment opportunity for truck drivers. They tend to be home longer, or they tend to know when they're going to be home, so it's more of a structured schedule, which is great for a better work-life balance. Some drivers are home every night, some whatever, a couple times a week, and so they have that ability to go work for those fleets. So and I think that it also tends to maybe pay a little better than irregular routes, just because to your conversation earlier, it's a higher service level, which requires a more professional driver. So a long-winded way of saying it is that the large fleets might want them for their dedicated businesses, because they're not really looking to seat additional trucks in their irregular route businesses, or and if they are going into those units, it's just for backfill to deal with natural attrition, which is always extremely high in the industry. I think now it's somewhere like 85-90%. I think that's like the latest data from ATA about turnover rates at the truckload in the truckload market. So yeah, I mean, I guess the good news is that this downturn in the spot market is happening at a time where there are opportunities for people to find different vocational careers.
Yeah, certainly. They're saying full or even more overfull employment. So it's a peculiar time for sure. But I think we don't have any further questions. So I guess what we'll do is we'll thank you, Lee, and we'll maybe, Lee, where can folks find you, and how can we follow you?
Sure. Both of my work is available to Bloomberg subscribers of the terminal. And for those that don't subscribe to the terminal, some of my stuff you can see at Bloomberg.com. If you want to get in touch with me, I'm on LinkedIn. I always like talking to transportation people. It makes my research better. You can find me on Twitter at LogisticsLee. So that's pretty catchy, I know. And happy to talk with people. In addition to trucking, I also cover rails, marine shipping, air freight, forwarders, freight brokers. So I kind of cover all modes of transportation that's moving stuff. I have colleagues that cover the movement of people. I don't deal well with people, so I just stick with the stuff.
And I can speak, from experience. I don't know, Lee, we met a few years ago, and I heard you speak somewhere, and we began talking. And Lee's spoken to a number of organizations that I'm part of, and I've very kind of quickly begun to see Lee as the best analyst out there in terms of knowing what is happening in the marketplace. So I encourage everyone to follow Lee, because he really has a very nuanced and sophisticated understanding, despite the fact that he's incredibly shallow. Just kidding. You put that out there. I did not. So I'm just jumping on it. No, but Lee is truly one of the best out there, and respect him and respect you, Lee, quite a bit. So folks, thank you for coming. Lee, thanks for joining us here, and enjoy the holidays and the new year, and we'll be talking soon.
Yep. Thanks for having me, and the kind words, and happy, healthy holiday and new year to everybody.
Thanks, everyone. Lee, thanks.
Yep. Take care.